In this week's video, the charts are very clear, and they'll help us understand why radical shifts in asset class behavior are flipping the investment script. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is the look of our long-term for illustrative purposes only weekly chart of the NYSE composite. This is before the election. We know from past videos that the probability of bad things happening is higher with this type of look here, and the probability of good things happening is higher with this type of look here. You can see before the election on November 4th, this is looking pretty tentative and dicey here. If we fast forward to Friday, November 18th, it looks a lot better, and we're back to a clean, full-bore, bullish look. Similar situation with the S&P 500 starting to look a little tentative and ugly in here with somewhat of a failed breakout look. Then we have a wonderful looking candle here, and this week's candle during the trading session on Friday, November 18th is also constructive. All things being equal, this looks a lot better than it did 3 weeks ago. Using the same 3 weekly for illustrative purposes only moving averages here, but this time we're using it on stocks versus bonds. You can see here the probability of good things happening started to improve in late 2012 and early in 2013. This look here is favorable for stocks over bonds. We have a very, very similar early stage look here, and you can see here when the probabilities improved, stocks outperformed bonds for a very long period of time. Heading into election week, was there any logical reason or any data-based rationale behind keeping some hedges in our portfolio? The answer is yes. This is risk on, risk off stocks versus bonds on Friday, November 4th. We have somewhat of a bullish breakout look here in favor of stocks, but then heading into the election, the ratio took a sharp turn in favor of defensive bonds. This is somewhat of an indecisive and tentative look, and the reason for that is that something like an election can be a binary event for the markets. Prior to the election, the basic theme that was driving asset class behavior in the financial markets was the lower interest rates longer theme, which is somewhat of a currency debasement theme. Low rates tends to favor bonds, dividend payers like REITs, dividend stocks. Gold and silver can help protect against currency debasement of paper currencies, which tends to also be favorable for gold mining stocks. Here's the same chart after the election on November 18th. Now we have the other binary outcome. We no longer have a lower rates longer theme driving the markets and asset class behavior. Now we're into the theme that we covered last week, which is a shift away from monetary policy and toward fiscal policy, expectations for higher inflation, higher growth, and instead of debasing the US dollar, you're supporting the US dollar with thoughts in the short run of actually raising interest rates, and the dollar has responded. Asset class behavior and favorable assets are almost binary opposites. Instead of this list that we were familiar with earlier in 2016, this type of situation favors stocks, and it favors small and mid-cap stocks over large caps, growth-oriented sectors such as energy, materials, retail, cyclicals, tech, banks, and industrials. This list here looks quite a bit different than this list here. And you can see this is a sharp and radical move in the stock-bond ratio here. This is the look before the election. This is the look after the election. Before the election, here's our theme. After the election, it's quite a bit different. And you'll see in this week's video, the market has shifted from here to here. Prior to the election, we said this was somewhat constructive here, that we were staying above this blue line. And with growth and inflation and higher GDP and possibly higher earnings per share coming down the pike, transportation stocks have responded after the election. Many of the charts that we were looking at told us to try to be patient with our core growth and stock-oriented ETFs heading into the election. This was one of them. There's also some concerns here, some weakness heading in, and that's one of the reasons why we kept some hedges in place as well. When you have some bonds and you have some gold and you have some silver in the portfolio, it can offset some of these positions that you're concerned about heading into the election. Higher beta stocks the Friday before the election, on Friday, November 4th, we were staying above the blue line. This is a try to be patient look here. What once acted as resistance, what once acted as resistance, what once acted as resistance may now act as support. In this case, support did hold, and this is SPHB on Friday, November 18th. It's possible the name of this ETF makes it more difficult for this ETF to attract assets. This term high beta, we all think high beta means wild and excessive risk. What exactly is SPHB, the PowerShares S&P 500 high beta portfolio? All it is SPY, basically, an S&P 500 type portfolio. See, S&P 500 is in the name, and the weightings are just different. They're more economically sensitive weightings. For example, SPY has about 16% of its assets allocated to financial services. SP high beta, almost 35%. Economically sensitive energy, 7% for SPY, almost 27% for SPHB. Technology is about the same, but in this environment, these are three sectors that look favorably from a mathematical perspective. The model does like them, and SPHB has 76% of its exposure in these favorable sectors from a probability perspective. Contrast that with SPY's 41%. A fair question might be, it seems like we've been making a lot of moves and rapid moves after the election. That's true, and there's reasons for that. Here's one example here. This is SPHB, or the high beta, relative to SP low volatility, which is basically the same thing. High beta overweights economically sensitive sectors. Low volatility tends to overweight the more defensive sectors. This is the 50-day moving average here. This is the 200-day moving average here. You can see this is a full-bore bearish look in February of 2016 against high beta and in favor of defensive and low volatility stocks. Now we have a full-bore bullish look on November 18th favoring the high beta sectors with price above both moving averages, the 50 above the 200, and the slopes of both are up. We'll walk through some other ratios and we'll see that many of these ratios were near possible resistance before the election. It's another risk on, risk off, or economically sensitive SP high beta relative to defensive oriented treasuries. Very, very similar situation here. Here we are in June of this year, really in August of this year, and we have a full bore bearish look against high beta and in favor of defensive treasuries. And even before the election, we had an indecisive and sideways look here, and we weren't able to break above potential resistance in favor of growth-oriented SP high beta. As you can see now, this isn't indecisive anymore relative to this consolidation period. Now we have a bullish breakout. The longer you go sideways, the bigger the move that you can expect to get when you break out. And we also have this favorable look with the 200-day turning up. The 50 has crossed above the 200-day. We had full bore bearish, now we're full bore bullish. All of this speaks to improving probabilities for SP high beta outperforming defensive-oriented TLT, as long as A, we hold this red line, and B, we maintain that full bore bullish look. Anything can happen going forward, just helps us with probabilities. Similar situation here. When we move from the themes that we've had, it also impacts capitalization. February of 2016, this is IWN small caps relative to SPY, the S&P 500. It's telling you here earlier in 2016 that the market was clearly favoring more defensive and blue chip oriented large cap over small cap. Full bore bearish look, like many of the other charts. We have a migration over to a look that's favoring now small cap stocks. The longer we go sideways and consolidate, the bigger the move that we can expect to get when we either get a bullish breakout or a bearish breakdown. This ratio has been inside of this consolidation box all the way back to 2014 here. This is 2015, 2016. The longer we stay above the orange line, the better for small caps relative to SPY. Doesn't mean SPY is going to go down necessarily. They both can go up. But with this look, it tells you that small caps are outperforming large caps. Virtually any risk-on, risk-off chart that we look at says very, very similar things and is sending similar messages. This is transportation stocks, obviously economically sensitive, IYT, relative to dividend-paying large cap. Think blue chips, so growth-oriented versus more defensive-oriented. Same situation here, full bore, bearish look in favor of defensive-oriented SDY, and we have that in August of this year. Prior to the election, we had that indecisive look here. We did have a bullish breakout here, but we hadn't cleared this area here. Now, after the election, we have a clear breakout above this consolidation box, and now we have that full-bore bullish look. This looks like the early stages of a new bullish trend in favor of transportation stocks over dividend payers. Doesn't mean dividend payers are going to go down necessarily. It just means the odds say that transportation stocks will make more money than SDY. Obviously, if this chart morphs back into a look like this, then that statement doesn't apply anymore. Let's take a little bit more of a longer-term view. This is risk-on, risk-off MDY mid-cap. So again, smaller than large-cap SPY relative to defensive-oriented IEF or intermediate-term treasuries in the ETF world. Same situation here. We have a long-term consolidation box that lasts a very long period of time. Now we have what appears to be a bullish turn in the 200-day and a full-bore bullish look. Down here, we have a consolidation in calendar year 2012. We break out above the box here. When we break out, we also are converting from a full-bore bearish look to a full-bore bullish look with the 200-day turning up. This is a much more favorable look in here than what we had here. And after the probabilities improved, the ratio rose for over 2 years, telling us that mid-caps significantly outperformed intermediate-term treasuries. This is calendar year 2013, 14, and into the highs in 2015. This period right here is similar to this look here. In fact, this one is even better because the longer we go sideways, the bigger the move that we can expect to get. This is roughly what we're looking at here, a 1-year consolidation box. This is a 3-year indecisive and confused market when the Fed was talking about raising rates and lowering rates, and we've covered that so many times. The Fed plays a very big role in this indecisive period here for 3 years. This is a favorable look in favor of mid-caps over IEF. If we go back into the box, that statement no longer applies. And if this morphs back into a full-bore bearish look, as we had in early 2016, it's no longer favorable for MDY relative to IEF. With the benefit of hindsight, you might say, why did you have any bonds in the portfolio and gold in the portfolio heading into the election? Well, this looks like a failed bullish breakout here in favor of TLT the Friday before the election. This isn't a particularly confidence-inspiring look here. There's a lot of white space below here. What happened after Election Day? This gap right here tells you that there was a significant and radical shift in expectations after the election in favor of growth-oriented stocks relative to defensive-oriented treasuries. It's a chart like this that helps us understand why we made so many moves to try to shift our defensive-oriented portion of the portfolio over to assets that align better with the market's current story. This chart tells us a lot here. This is the 200-day moving average in red and the 50-day moving average for bonds versus stocks. The intermediate term trend is unfavorable for TLT relative to SPY. And when this rolls over here, it's telling us that the long-term trend is unfavorable for TLT relative to SPY. It also tells us that the long-term trend favors SPY or stocks over TLT from a probability perspective on Friday, November 18th. This chart here helps us understand why we've been migrating from a more defensive stance. This is in favor of bonds here earlier in the year. This is late October of this year. The slope of the 200-day moving average is still favoring defensive-oriented bonds relative to stocks. This look here is quite a bit different than this look here, and that's why our asset class mix is quite a bit different over here than it is over here. Remember, we talked about inflation expectations picking up in late 2008, early 2009. The stock market bottoms in here, and good things happen for growth-oriented assets. This is the same look after the election. And of course, inflation expectations align with this tweet. When we have multiple pieces of hard data or multiple charts or multiple risk-on ratios that are telling us the same thing, that speaks to the weight of the evidence, and it also speaks to confidence to be able to migrate more rapidly. This is a downtrend here, resistance here. This is September of this year. We finally get a breakout. This looks like a successful retest here. So when we're below this blue line, the trend favors defensive-oriented IEF over growth-oriented XLE. Now we have a bullish breakout. This, from a probability perspective, is more constructive here than here, or any time here. Exact same theme and why we're migrating towards growth and why it took us time to do it. This is one good step. Step one of a trend change for the ratio of growth-oriented retail relative to defensive consumer staples stocks. This is a defensive look here. We get a bullish breakout. Then we make a higher low relative to this low, and step three is a higher high. We have the higher high, but we didn't get it until after the election. Remember, a week ago, we covered Trump's platform and the possible impact on asset class behavior. The things that we talked about last week, did any of it align with what happened in the following week or the last 5 trading sessions? The answer is a definitive yes. Last 5 trading sessions after we covered all of these bullet points from last week's video. Banks up over 4%, small caps over 2%, mid caps almost 3%, metals and mining 2.3%, transportation 3.3%, total stock market 1.22%, outperforming SPY, energy outperforming at 2.4%, high beta that we talked about cremating SPY up 3% up less than 1%. So when we look at those ratios, it doesn't mean SPY can't go up. It just means SP high beta has a higher probability of going up intermediate and long term as long as the charts look as they do today. Compare and contrast this favorable looks here with the underperformers. Underperforming this week, defensive consumer staples were down. A diversified basket of bonds down. So asset class behavior since the election and since we covered these bullet points 5 trading sessions ago still aligns with everything we postulated last week. Something else that we touched on last week and it continued this week, this type of asset class behavior has been occurring on very impressive trading volume. When we see the types of slopes that we have on those ratios, that speaks to conviction. The gap that we saw on the stock bond chart speaks to conviction. Trading volume speaks to conviction, and asset class behavior speaks to conviction. All of that speaks to, and we all know the answer, probabilities. Here's an example. We're getting very, very strong trading volume. This is the broad Wilshire 5000 stock index. It is breaking out from and making a higher weekly high. This is a consolidation box. If you've been frustrated and if you're running a long-term trend following model, this is the type of chart that gives you nightmares and you wake up in a cold sweat. This is 3 years of indecisive behavior. And that's not particularly abnormal. This one's lasted longer and we've had big swings, but it's not abnormal to get consolidation. This box is the bad news. The good news is if you can remain disciplined and consistent and keep your emotions in check. We also have the familiar expression from these videos. Harder markets are often followed by easier markets, are often followed by easier markets. Harder markets are often followed by easier markets. We don't know what's going to happen here. All we know is what we have in front of us. And right now, this looks constructive. Unfortunately, when you have a 3-year consolidation box, most people will not have the discipline to stick to the system. And unfortunately, most of them will bail out somewhere over here right before a more difficult market shifts into an easier market. Therefore, rather than being upset about something we can't control, a 3-year consolidation box, we can focus on the positive, which is our discipline has been outstanding. And eventually, that will most likely show up in our bottom lines. Probably only 1 in 500 people has the necessary discipline to be successful. So, quote from the market wizards. We've covered numerous favorable setups in this video. Here's one of them. Here's another. You can make a case this is a bullish inverse head and shoulders pattern, and we have successfully exceeded the neckline. We have breakdowns in defensive assets. We have many markets breaking out of long-term consolidation boxes with constructive trends. The slopes of these lines tell us we have a constructive longer-term trend in place. Our weekly chart is back to a full-bore bullish look, and we know historically good things tend to happen after we get a turn like this. Therefore, we'll head into next week with that always flexible, unbiased, and open mind, understanding that if we continue to execute properly, difficult markets are often followed by easier markets. Time will tell. These are just setups, and we will head into next week open to all outcomes. Some asset classes responded favorably after the election and some not so favorably. Here we have a bullish look here. As long as we're above the blue line, we said we'd learn something either way. Well, as of Friday, November 18th, during the trading session, we're below the blue line now. The probability of good things happening in emerging markets is higher above these blue lines, and now it's lower. It doesn't mean good things can't happen, but it just speaks to probabilities. We now have observable evidence in hand that's concerning for gold, especially if we're expecting gold to lead in the short run. Now price is below a 200-day moving average. It looks like it's starting to flatten out. And even more concerning, we're below both the 38.2 normal retracement from this A to B move here, and now we're below the 50% retracement. So the probability of bad things happening is higher today than it was up here. Similar situation here. Before the election, IEF is above all of the fibs that we've been talking about, and it's still above a rising and bullish 200-day moving average. Not the case anymore. We're below both 50% retracements. We're below the 200-day, and it looks like it's starting to roll over. This doesn't necessarily mean that TLT and IEF and GLD are dead in the water, but it does probably tell us from a leadership perspective and an opportunity cost perspective, there's probably better places for our hard-earned capital. Everything that we just said about the prior chart applies to TLT. The only difference is we're below all three of the major fibs, and it almost looks like a breakdown below the third fib here, and then a retest of the breakdown, and then a lower low. That's not a particularly good look at 11:13 a.m. on Friday, November 18th. We covered three charts that their fibs and 200-day don't look particularly good anymore. That would be TLT, IEF, and GLD. All of our core stock positions look better from that perspective. This is heading into the election, SPY, Friday, November 4th. You can see we're at the 50% retracement and well above the blue 50% retracement. And heading into election week, we still had this constructive slope here. And remember what this tells us. This tells us that this looks like a normal pullback within the context of an ongoing uptrend. And that implies that eventually you would go on to make a new high if the uptrend remains intact. It doesn't tell us that's going to happen. It just helps us with odds. The odds of being patient and having it pay off are higher here than they are down here. Trying to be patient down here starts to get a lot less favorable from a probability perspective. If we fast forward to the present day, we did indeed go on to make a new high. Now we have a series of higher highs and higher lows, which is the definition of an existing and ongoing uptrend. Prior to the election, we said bonds had bounced here, here, and here, and then good things happened. We said there was a chance that they might bounce again. They didn't. Like all charts, we'll learn something either way. What we learned here was not particularly favorable for TLT, especially in the short run. The chart of small caps prior to the election, this is on November 3rd, really helps us understand the radical shift into the election. This is ugly looking. Now this looks like a failed bullish breakout. If we fast forward to Friday, November 18th, you can see post-election with the new drivers, small caps look a lot better today than they did in early November, and they've also gone on to make a higher high above these highs here. Before the election, the NYSE composite looking very, very dicey. This is a breakout here, a failed breakout, and many people are frustrated in this market, and understandably so. On Friday, November 4th, the broad stock market was still 9% below the high from 2015, and unbelievably 8% below the high that was made 2.4 years earlier. It has been a difficult situation. It looks like it might get a little bit easier going forward. This is our more concerning look before the election. How does the same chart look today? Quite a bit better. We're back above this 61.8% level. One of the reasons why we have shifted so quickly here, under our system, when a trend emerges and you have the setups that you need, it is extremely important that you execute according to the data in front of you. Why? Because you have to offset these long-term frustrating periods with profits during what may be now an easier period. Let's walk a little bit through the model. What the model basically does, it says we want to put our capital in harm's way when the odds are in our favor. When the odds are clearly unfavorable, we want to be out of harm's way or in defensive assets. And when markets are indecisive, our allocations will be indecisive and we will be flexible. With the benefit of hindsight, when you get above this box here, this is a monthly chart of the S&P 500. It's easy to say we should have bought here. We have to understand when we're in a consolidation box, when you make it to the top of the box, you can move to the bottom of the box. So when we rally off of this low here, we are still in the consolidation box. And when we get up here, even in May, June, and July, we don't know if we're going to go above the box or we're going to return all the way to the bottom of the box. When you're in a box that's indecisive and it speaks to higher risk and uncertain probabilities. Let's show a couple of cases. Let's assume, with the benefit of hindsight, you've said, well, you should have bought this. I've been doing this a long time and I've seen a lot of markets. Here we are here. We're in a consolidation box with a broad NYSE composite for 2.7 years. When we come, we get what appears to be a bearish breakdown. Then it becomes a failed breakdown. If you threw caution to the wind and ignored the evidence in hand and bought this low aggressively, and you had gains from here to point A up here, but notice this, you're at the top of the box, you move to the bottom of the box. When you start to rally, you are still in the box. We basically make an assumption that we're going to stay in the box until proven otherwise. But let's assume that this is February of 2016 and we aggressively bought the low and we basically guessed. What happened next in this case? We never broke out of the top of the box. We stayed in the consolidation box and eventually the market moved from point A to point B. From point A to point B, if you bought here, this drop here in the S&P 500, this is a 42% drop. In the NYSE, a 37% drop. If we look at the chart of the NASDAQ, it dropped 52% from point A to point B. Was there evidence in hand in 1998, 2001, this period here, that told us to be skeptical about this rally? This is a monthly chart, and this is point A here. This is the early spring, or the spring of calendar year 2001. If we move to a daily chart, this is the early spring of calendar year 2001, and this is the same point A here. Notice we have a high-risk profile. This is a full-bore bearish look with price below both moving averages. This is a bearish slope in the 200-day. Look how similar this looks to the low in February of this year. This actually looks worse because the 50-day is below the 200 for 6 months here and only 4 months here. This is a low probability setup here. And we don't want to put our capital in harm's way when we have a low probability setup. Why? Because out of low probability setups, really bad things can happen, like the losses that we just discussed. Let's assume in this case I aggressively guessed and I bought the low here at the bottom of the consolidation box, which would be similar to guessing that things were going to improve and buying this low. You did get a gain from the L to point A here, But look how quickly it was wiped out. This gain here was wiped out in a matter of days, and then significant losses followed. Why is that relevant when we're thinking about this being a low probability setup? Because when you put your capital in harm's way in a low probability setup, more often than not, not always, bad things happen. And sometimes it can be really bad things. If we lost 37%, 42%, or 52% on $1 million, if you lose 52%, which is the drop on the NASDAQ from point A to point B in this period, you have to make 108% just to get back to break even. This is a low probability setup under our system and our time frame earlier in 2016. It looks easy to buy it with the benefit of hindsight. Said I've been doing this a long time. 2016 looks very, very similar to a low probability period in calendar year 2008. 50-day, 200-day in 2016, full bore bearish look. Full bore bearish look here early in 2008. If I guessed and bought this low and ignored the low probability setup, what happened next? Eventually, I was rewarded because we did go back above the box here. We rallied from the low here all the way back to a downward sloping 200-day moving average. Notice, this is a counter trend rally within the context of an ongoing downtrend. If I bought aggressively here and ignored this, what happened after that? Really bad things happen. This is a low probability entry point, and in this case, you were not rewarded for guessing on a longer term time frame. The S&P 500 from point A here lost an additional 47%. If we lose 47% on $1 million portfolio, we will have 530,000 left at the bottom here. To get back to break even where we were here, we need to make 89% on our 530,000. So therefore, it is reasonable to say the market, the S&P 500, is up X% year to date. But you have to also understand, if that's your benchmark, then you also have to be willing to accept a 47, 52, or even 70% loss in the case of the NASDAQ in the dot-com bust. We look at risk-adjusted situations. It doesn't matter what happens off of this low. This is a low probability setup, which mathematically is indisputable. We executed properly. In this case, the lower probability outcome was the outcome, and we know that. We went on to make a higher high, which was very, very different than what happened in calendar year 2007, 2008, and 2000, 2001. So when the stock market bottoms in February, this is our look with the 50-day and the 200-day in 2016. This looks very, very similar to these low probability periods we just covered. And it looks easy with the benefit of hindsight to say, well, we should have guessed and bought this because we're up here now. Well, this wasn't an easy move here. We have to remember, when we're coming off this low, we have a downward sloping and negative 200-day here. And then after Brexit, the S&P 500 futures overnight went limit down. Price dropped below the 200-day moving average, and the 50-day started to roll over. And we're still inside the long-term consolidation box. This is a very indecisive and higher risk profile. The benefit of hindsight, this looks easy. Not only did we have one evening where the S&P 500 futures went limit down, we had a second one that occurred in a matter of months on the night of the U.S. election. You may ask, why did we hold on to our SPY and our stock positions? Because we did have evidence that we've covered with the fibs and things like that that said we should try to be patient. Look how long the 200-day moving average has been sloping up here compared to here. This is a much stronger trend here. Also, when we go into Brexit, we have not gotten out of the consolidation box. When we go into the U.S. election, we've made a higher high above the box. This profile here is quite a bit more constructive than this profile here, and it called for some patience. When you see this, it's easy to say, well, we shouldn't have owned any bonds and we shouldn't have had any gold heading into the election. Well, if you didn't follow along closely overnight on election night, so this is early morning, November 9th, this is from the Wall Street Journal, the S&P 500 futures plunged 5%. Gold, one of our hedges, was up over 4% overnight, telling us that the hedges that we kept in place, some of them, not all of them, we did reduce our gold position significantly before the election. It was helpful. This was not reflected in the next day's trading session, but this is the plunge. This is a waterfall decline that took place on election night, and it sure felt good to have some hedges in our portfolio to offset our stocks. U.S. Treasury bonds, which are also viewed as a safe haven asset, were rallying on election night. So the bonds that we kept and the gold that we kept, the hedges, did what we wanted them to do. After election night, things changed. And if you look at your portfolio, we have now removed most, if not all, of those hedges because the market's profile has improved. Similar situation with the Dow. This is the present day. It was inside of a consolidation box for 3.4 years. If you aggressively buy this low on our time frame, we don't know when we get up here. When you get back to the top of the box in a consolidation pattern, you can move to the bottom of the box. We got back to the top of the box. It's prudent to see what happens. We had a bullish breakout, a failed breakout, and now this chart as of November 17th looks much, much better than it did here, here, or here, as long as we stay above the orange box. Now we know the probabilities are more favorable here than they were at any time in this box here. We want to put our capital in harm's way when the odds are in our favor. Above the box, we know from a probability perspective, the odds are more favorable that good things can happen. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog short takes, or watch past videos on the Shivako Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.